Welcome to our deep dive into private equity secondaries. Let's start by understanding what PE secondaries are all about. Private equity secondaries involve selling fund stakes before maturity, providing crucial liquidity in an otherwise illiquid asset class. This market acts as a vital mechanism, offering both liquidity and flexibility. It allows existing private equity investors to sell their fund stakes before they mature, which is a game changer for portfolio management. The core function of this market is to provide much-needed liquidity and flexibility in an asset class traditionally known for its illiquidity. This market has exploded, growing into a multi-billion-dollar ecosystem that continues to expand rapidly. Now, let's differentiate between LP-led and GP-led transactions. LP-led transactions are driven by limited partners looking for liquidity or to rebalance their portfolios. Limited partners, like pension funds, endowments, and family offices, sell their fund commitments. These sales are primarily driven by liquidity needs, portfolio rebalancing, or considerations related to the fund's life cycle. GP-led transactions, on the other hand, allow general partners to extend ownership of key assets and offer liquidity to existing investors. General partners initiate these transactions, often through continuation funds. Their motivations include extending ownership of high-performing assets, offering liquidity options to existing LPs, and attracting new capital. So why do buyers flock to secondaries? Buyers benefit from reduced blind pool risk, as assets are already visible, and they achieve diversification across vintages, sectors, and geographies. They also enjoy a faster cash flow profile with a shorter J-curve and access to top-tier PE managers who might otherwise be closed to new commitments. Let's talk about pricing in the secondaries market. One major advantage for buyers is reduced blind pool risk. The assets are already visible and seasoned, offering greater certainty. Secondaries provide excellent diversification opportunities across different vintages, sectors, and geographies. Buyers also benefit from a faster cash flow profile with a shorter J-curve compared to making primary commitments. Crucially, secondaries offer access to top-tier private equity managers who might otherwise be closed to new investments. Pricing in the secondaries market is primarily based on the net asset value, or NAV, of the underlying fund. This means the valuation is tied directly to the value of the assets within the fund. Discounts are common, particularly when sellers face liquidity pressure or during periods of market volatility. These discounts and premiums are influenced by a range of factors, including market conditions and seller motivations. Conversely, premiums can occur for highly sought-after funds that boast strong performance records. A significant development reshaping the secondary market is the rise of continuation funds, driving a GP-led boom. These are special-purpose vehicles set up by general partners to hold specific high-performing assets. LPs can choose to cash out or roll over their investment into the new fund, while GPs extend control over valuable assets and maximize their exit value. Let's look at the market overview and the key players dominating this space. Leading the charge are major secondary funds such as Ardian, Blackstone Strategic Partners, Lexington Partners, Collar Capital, HarborVest, and AlpInvest. The market is projected to exceed $150 billion annually by 2025, fueled by both LP-led sales and GP-led deals. The impact of secondaries on the private equity ecosystem is profound, enhancing both liquidity and transparency. It acts as a crucial release valve for liquidity in private equity, effectively solving the exit backlog. Secondaries enhance transparency, encourage greater institutional participation, and support flexible portfolio management. What was once a niche tool is now considered a mainstream strategy within private markets. To wrap up, private equity secondaries are a cornerstone of the maturing private equity market. They provide liquidity for sellers, diversification for buyers, and extended value creation opportunities for general partners. In essence, PE secondaries deliver liquidity for sellers, diversification for buyers, and continued value creation for GPs. They have become a critical pillar of the maturing private equity market, indispensable for its continued growth and efficiency. Please note this content is for educational purposes only and does not constitute financial advice.